In the US, FIRE followers live by the 4% rule. Save enough money, invest it, and you can quit your job forever. But in Japan, that same math can backfire fast. Here, retiring early might not mean freedom. It might mean running out of money before 70. So, please click the like button and subscribe, and let's talk about why FIRE in Japan is way tougher than it looks. If you spend even a few minutes online, you'll find stories about people who've done it. They quit their job in their 30s or 40s, travel the world, and live entirely off their investment. It's called FIRE, financial independence, retire early. And for a lot of people, it sounds like the ultimate freedom. No more bosses, no more alarm clocks, just living the life on your own terms, funded by passive income. And that dream isn't just in the US anymore. Here in Japan, more and more people are trying to reach FIRE too. Tired of long work hours, corporate hierarchies, and financial uncertainties. With inflation finally back, wages slowly rising, and the NISA program making investing tax-free for decades, it's easy to see why. For the first time in years, people are actually talking about financial independence, not just saving money. But there is a catch. The math that made FIRE possible in the US doesn't always translate to Japan's slower economy and lower investment returns. So, is early retirement here still possible, or just a beautiful illusion? If you have followed FIRE at all, you've probably heard about the famous 4% rule. It came from a study from a financial planner called William Bengen, and he looked at decades of stocks and bonds data and basically said the following, and I'm paraphrasing here. If you retire with a balanced portfolio, about 50% stock, 50% bonds, and withdraw 4% of your portfolio in your first year, adjusting for inflation after that, your money would probably last 30 years or more. In other words, with $1 million, you could safely spend $40,000 a year, and statistically, you'd be fine. Recently, though, even Bengen himself and others have adjusted their views, suggesting withdrawal rates closer to 3.3 or 3.7% to be safer. But for decades, this rule gave Americans the confidence to quit their jobs. If you've learned anything so far, please consider giving this video a like. That would make it available to many more people and help us a lot as well. Thank you so much. Let's continue. Now, let's take that same rule and test it here in Japan. Over the last 30 years, the Topix index has averaged about 3.6% per year. Even if you look at the last 20 years when Japan finally started recovering, the average return is closer to 6%, not the 7 or 8% that Americans have enjoyed so far. For most of that time, inflation was almost zero, which was great for shoppers, and I enjoy it, but not so great for investors, which was not so good either. And because your portfolio wasn't compounding much in real terms, you didn't get as much returns. Now, inflation is back, around 3% in 2024, depending on the statistics you're looking at. But wages haven't caught up completely, and the returns, which were excellent for 2 years or 3 years, are slowing down again. So, if your investment just grows by 3.6% a year, but you withdraw 4%, your money is shrinking, right? Slowly, but surely. And even if we're looking at 6% returns, after inflation, you're still barely breaking even. And that's why the 4% rule, at least as Americans use it, doesn't work in Japan. Now, let me put real numbers on this to be practical. Say you've managed to save 100 million yen, which is about $660,000 at today's exchange rate. In the US, following the 4% rule, that means you could spend 4 million yen per year, roughly 330,000 yen per month, and your portfolio could last 30 years or more. But here in Japan, with slower growth, longer life expectancy, and limited inflation protection, that same 4% withdrawal rate could drain your saving before you even hit your late 70s. And let's be completely honest here, saving 100 million yen isn't easy. Because if we look at statistics, the average retired couple in Japan only has about 25 to 30 million yen in retirement assets. That's a quarter or a third of the way of what we just talked about. So, if in the US you can retire with $1 million, The Japanese reality says you might need to triple that just to get similar security. Of course, in Japanese yen. And that's the arch math of FIRE in Japan. So, if 4% doesn't cut it, what does, you might ask? Some planners suggest a 2.5 to 3% withdrawal rate for Japan. That means if you want to live on 3 million yen a year, you need about 100 million yen invested, not 75 million, which is 3 times the average couple retirement fund that we just talked about. But the real solution isn't just lowering your spending or having more saved for retirement. It might be to build smarter systems. Of course, you need to use NISA and iDeCo or DC to grow your investments tax-free for decades. You need to diversify globally, not just domestic funds, but US and global index funds and ETF that can lift your long-term returns closer to 6, 7 or even 8% and will give you more leeway with your withdrawal rate. Sorry, that was a difficult one. Consider dividend ETFs or rental income to cover part of your living costs. And actually, rental income is really what has been driving the FIRE conversation here. Although it has become tougher with the growth in the real estate market prices over the last few years. And maybe you should redefine retirement. By that I mean, be flexible or go part-time work on your own terms to extend your runway dramatically. So basically go back to work, but not full-time. So FIRE in Japan may not mean never working again, but it can mean working because you want to, not because you have to. And of course, the lifestyle that you're living matters. A single person in Tokyo might spend 250,000 to 300,000 yen per month just on basics, and a couple might as well if they've paid off their house. But if you look at Fukuoka, Sendai or Sapporo, the same lifestyle might cost 30% less, according to the Ministry of External Affairs and Communications statistics from 2024. That's food for thought, isn't it? So the question is FIRE in Japan possible? The answer is no, if you copy-paste American math. But it can be a yes, but it has to be leaner, slower, and harder than what you'll hear from American FIRE gurus. In Japan, the safe withdrawal rate is lower. The savings target is higher. And the journey might take longer. Actually, it would take longer. But with NISA, global diversification, and smarter income strategies, financial independence is still achievable. But on Japan terms. If this reality check helped you, please like and subscribe for more insight about personal finance and life in Japan. And the next episode in this mini-series should be super interesting, so don't miss it. And you can check this video up here while you're waiting for it. Thank you again for watching, and until next time, goodbye!